All right, let's talk about cutting through all the chaos you see on a financial chart. Seriously, instead of just seeing a bunch of random squiggles, what if you could spot the actual footprints left behind by the market's biggest players? Well, that's what we're doing today. Let's dive right in. This is the question every single trader asks themselves, right? How do you find any kind of order in all that noise? Today, we're not just going to talk about theory. We're going to lay out a concrete framework so you can actually spot these footprints and, more importantly, turn them into a real advantage. Look, it doesn't matter if you're brand new to this or you've been trading for years. We're all on the same quest. We're all hunting for that reliable, repeatable edge that we can actually count on. An edge, it's not about having some magical crystal ball, right? It's really about having a solid, methodical approach that helps you stack the odds in your favor. It's about turning that chaotic-looking chart into a clear roadmap. So, let's start building that map, starting with our very first landmark. Okay, the first piece of our puzzle is a really powerful visual signal. It's a candlestick pattern that basically acts like a giant flashing light, telling us that the balance of power in the market is shifting, and shifting dramatically. So here it is, our foundational signal, the bullish engulfing pattern. And it's pretty simple. It's just a two-candle formation, but man, does it scream reversal. So just imagine the price has been dropping. That's our downtrend. When you see this pattern pop up at the bottom, it's a huge clue that the sellers are getting exhausted and the buyers are charging in with some serious force. And what's so cool here is the story that these two little candles tell. You've got that first small red candle. Yeah, sellers are still in control, but you can see they're getting tired, they're losing momentum. And then, bam, this giant green candle doesn't just push back, it completely engulfs the previous candle. It's like a visual of an aggressive, decisive takeover by the buyers. And that quote just nails it, doesn't it? It's a sudden, overwhelming show of force. Think of it like a changing of the guard. So this pattern tells us what is happening. But, a signal all by itself isn't enough. To really understand why it's so important, we have to look at where it's happening. We need to add some context. So we've got our signal. But honestly, a signal in some random spot on the chart, that's just noise. We need to find it in a very specific area that actually matters. A place where the market has left behind some clues, or what a lot of traders call unfinished business. And this brings us to the fair value gap, or FVG for short. Think of it like this. When the price just sprints in one direction, it sometimes kind of leaps over certain price levels, leaving this little gap behind. That's your FVG. And it's unfinished business because, well, the market often likes to circle back and fill in these gaps to bring things back into balance. Now, spotting one is actually pretty straightforward. Here's the simple three-step recipe. You're looking for a three-candle sequence. The candle in the middle is that big, powerful, impulsive move. The secret is to look at the top of the first candle and the bottom of the third candle. If they don't overlap, that empty space between them, that's your fair value gap. That's the zone of imbalance we're looking for. So why do these gaps even show up? Well, it's usually because of institutional activity. I'm talking huge funds placing massive orders. They can suck up all the available orders at once, which forces the price to literally jump, leaving these gaps behind. So these aren't just random patterns, they are the literal footprints of the big players, and that makes them incredibly powerful areas for us to watch. Okay, so we've got our signal, the engulfing pattern. And we have our context, the fair value gap. Now we just need that final piece of the puzzle, the precise trigger that gives us the green light, the confirmation we need to actually enter a trade. And that trigger is called the change of character, or ChoCH. If the bullish engulfing pattern was the earthquake, then the ChoCH is like the very first aftershock that confirms, yes, the ground is definitely shifting beneath our feet. It's the earliest sign you can get on a smaller time frame that a reversal is really happening. Okay, so you might be wondering, what's the difference between this change of character and a regular old break of structure? It's actually really simple. A break of structure, or BOS, just confirms the trend is continuing. In an uptrend, it's making a new higher high. But a ChoCH, that's the very first sign the trend might be breaking. So in a downtrend, if the price suddenly breaks above the most recent little peak, that's our bullish ChoCH. It's the first hint that the downward momentum is starting to fail. This analogy is absolutely perfect. A break of structure is just taking the next logical step up the staircase. But a change of character, that's when you stop, physically turn around and take a step in the complete opposite direction. It's a fundamental shift in behavior, and that is exactly the kind of confirmation we want for our trigger.
All right, we did it. We have our signal, we have our context, and we have our trigger. Now for the fun part. Let's see how these three things combine to create a solid, actionable playbook you can actually use.
First things first, the setup. We are not chasing the market, ever. Instead, we're going to act like patient hunters. We identify a high probability area on our chart, maybe a key support level or what's called a demand zone, and we simply wait for the price to come to us. And then, right inside that zone we were watching, we get our signal. A nice, clean, powerful bullish engulfing pattern forms. This is our first major clue. It tells us that buyers aren't just hanging around, they are aggressively taking control right where we expected them to show up.
Now, let's add our context. That big engulfing move was so aggressive that it left behind a fair value gap. And this is a huge confirmation because it tells us that the buying pressure was so strong, it was literally inefficient. It left behind that institutional footprint we were looking for.
And this is exactly where our opportunity lies. You see, the market loves to fill these little vacuums. So we anticipate that the price will probably pull back to retest this brand new fair value gap. This area now becomes our prime hunting ground for an entry.
And finally, the trigger. As the price pulls back into our zone, we don't just blindly jump in. No, we zoom into a lower time frame and we patiently wait for that bullish change of character. Once that ChoCH is confirmed, usually with a candle close, that's it. That's our final green light. It confirms that buyers are in control on multiple time frames, and that gives us a truly high probability entry. So, is this the holy grail of trading? Of course not, nothing is. But what it is a powerful logical framework that helps you read the market story. By combining the what, the why, and the when, you can shift from just randomly guessing to executing a disciplined plan. So the real question I'll leave you with is, how are you going to use these footprints to start building your own trading map?